The foreign exchange market, or Forex, is the largest financial network on the planet. It is a decentralized, over-the-counter market where global currencies are traded continuously at lightning speed. Because of that speed, many newcomers view Forex as an arcade for making quick cash. But the reality is that the sheer volatility of these currency pairs will rapidly drain the accounts of anyone trading on instinct. If you enter this space without a rigidly defined set of rules, you aren't actually trading. You are simply gambling against institutional banks and powerful market makers who control the vast majority of the volume. The notorious FX methodology is built to counter that chaos. Instead of relying on gut feelings, it treats trading as a strict, emotionless business operation governed by absolute parameters. Before you can even begin to analyze a price chart, you have to strip away those gambling habits and learn the baseline mathematical language that dictates how a trade is actually executed. This graphic shows the basic measurement in Forex, the pip. It expresses tiny changes in value between currencies, calculating movement down to the 4th or 5th decimal place. To measure accurately, traders break this down into points, where 1 pip equals 10 points. But a pip is just a measure of distance. To translate that distance into actual money, you have to determine the financial size of your position using a metric called a lot. This graphic breaks down how lot sizes dictate your cash risk. A micro lot, entered as 0.01, means every pip the market moves is worth 10 cents. Scale that up to 1 standard lot, and every single pip of movement equals $10. Understanding exactly how your lot size multiplies your pip movement is the absolute baseline requirement. Without it, you cannot accurately manage your capital or safely navigate market structure. Once you know the math, you can read the movement. Looking at these graphs, the market does not move randomly. It steps in distinct, identifiable trends. A bull market characterized by climbing peaks, and a bear market defined by a sequence of descending steps. On this structure diagram, we identify a bear trend by tracking these sequential nodes. Price forms a lower high, then a new lower low. Pushing past the previous lower low creates a break of structure, or BOS, signaling the downward trend continues. This chart illustrates the critical warning sign that a trend is dying. When the price fails to make a new low and instead aggressively surges past its previous peak, it triggers a change of character, indicating a reversal. By tracking these breaks of structure and changes of character, you stop trying to guess where the price will go and start reading the undeniable footprints left by institutional capital. Institutional players actively use these patterns against retail traders. This chart demonstrates inducement. During specific times, like the Asian session, market makers will push the price just outside the established range to deliberately trigger the stop losses of regular traders, sweeping their liquidity. Looking at this entry diagram, the notorious FX model relies on patience to avoid those traps. The trader waits for the change of character to happen first. Then they wait for the price to pull back into an established institutional order block before confirming the entry. This Fibonacci diagram shows mathematics reinforcing entries. Traders align the tool over the price wave, checking if order blocks line up with deep retracement levels like the 0.88. It also works in reverse, mapping precise horizontal target levels for taking profits as price rebounds. Fusing structural chart patterns with the rigid math of Fibonacci levels strips the emotion out of the process, leaving you with a highly defined, mechanical plan of execution. Yet you can map the structure perfectly, nail the entry, and still lose your account entirely if you ignore strict money management. This outlines capital allocation rules. Dictated lot sizes must be tethered to your capital. For a $300 account, your lot size cannot exceed 0.01. This supports the most vital rule: never risk more than 1% per trade. Looking at this risk-to-reward graphic, the small red stop-loss blocks are dwarfed by the massive blue take-profit targets. A 1-to-10 ratio means risking 30 points to capture 300. With this math, one successful entry outweighs a series of losses. FX Notorious emphasizes that these mechanics must be drilled repeatedly on a simulated demo account until they become second nature, long before you ever risk a cent of real capital. True financial independence in the markets isn't born from having a crystal ball. It is earned through systematically executing an emotionless, deeply risk-managed business framework every single time you sit down at the screen.